Volatility is active, but structure is still being negotiated between repeated session anchors. The visible movement can look directional at first glance. But the more important condition here is not the size of the candles. It is the repeated formation of session anchors in nearly the same positional region. That is what makes trading between sessions concrete on this chart rather than abstract. The March 9th U.S. session anchor box did not form in open space. It formed directly on top of the positional area already established by the March 6th U.S. session anchor box. That matters because the market did not relocate its working area before the new U.S. session anchor appeared. It reproduced it. When a later session anchor forms where an earlier session anchor already carries structural memory, interaction frequency rises. Price does not need to travel far to remain active. It can continue moving while still remaining trapped inside familiar structural territory. That is the first condition that makes between-session trading visible. Now that overlap did not stop with the U.S. session alone. The March 9th Asia session anchor also formed around the midpoint of the March 9th U.S. session anchor box. This means the U.S. session did not simply hand off to Asia through empty distance. Asia inherited a box already loaded with recent structural weight. That inheritance is the core of the idea. This is not just one session reacting to itself. This is one session processing inside the unfinished work of another. That is what turns the phrase trading between sessions into a chart event. And the structure became even denser when the earlier March 3rd Asia session anchor is added to the same region. Now, the chart is no longer dealing with one isolated box. It is dealing with repeated anchor memory from March 3rd, March 6th, March 9th US, and March 9th Asia. Several anchors are telling the market to keep returning to the same area. That repeated return changes execution conditions immediately. Distance tolerance contracts. Continuation attempts have less room to breathe. Narrow tolerance gets exposed faster. Small failures begin to matter more because the structure is already crowded. This is why session overlap compression is not just a visual observation. It changes how price behaves inside the area. A movement that looks like expansion can still be internal rotation when several anchor boxes are layered together. The candles may travel. The structure may not. That is exactly what makes the next development important. After the March 9th Asia session anchor formed near the midpoint of the March 9th US box, price moved upward. It tested the upper boundary of the March 9th US session anchor box. Then it pushed through that boundary. And after that, it continued testing the upper boundary of the March 5th Asia session anchor box. This sequence makes the idea visually specific. Price did not randomly rise. It climbed from one inherited session boundary into the next visible session boundary. The chart was not moving through empty momentum. It was negotiating between stored session structures. That is what between-session movement looks like when it becomes concrete. The path is defined by prior boxes. The pressure points are defined by prior boxes. The distance is measured by how far price can travel from one inherited session boundary before the next structural memory interrupts continuation. If overlap remains dominant, distance stays limited. If inherited boundaries keep attracting price, continuation stalls more quickly. If displacement begins replacing rotation, retracements usually deepen before stabilizing. Execution conditions remain in transition. The next visible shift formed when the March 10th U.S. session anchor box appeared between the lower boundary of the March 5th Asia session box and the 20 moving average. That location matters immediately. The new U.S. anchor did not appear at a fresh expansion zone. It formed inside a preloaded corridor. Below it sat the lower boundary of the March 5th Asia session box. Near it sat the 20 moving average. Above it remained the upper boundary of that same March 5th Asia session structure. So even before movement expanded, the environment was already narrow. The market was boxed by prior session memory below and above, while the 20 moving average sat nearby as active structural weight. That kind of placement increases friction. Price can still move aggressively there, but tolerance is smaller than the candles first suggest. From that March 10th U.S. session anchor, price pushed upward and moved through the upper boundary of the March 5th Asia session box. On the surface, that looks like clean continuation. But the chart immediately showed why visible movement alone was not enough. The next test reached the lower boundary of the March 5th U.S. session anchor box. That interaction occurred near the upper 20 Bollinger Band, and continuation failed there. This is where the behavior becomes useful. The market moved from one inherited box through another inherited boundary into the lower edge of yet another earlier U.S. structure. That is not random activity. That is a chain of between-session negotiations. Each boundary changes what the next movement is allowed to sustain. The failure at the lower boundary of the March 5th U.S. session box is especially important because it happened while the 20 Bollinger Bands were already sloping downward on both sides. That slope tells us the broader hourly environment is leaning lower in structural pressure. So when price reached that upper interaction zone, continuation did not gain durable distance. It lost it. Pullbacks deepened quickly. Continuation compressed. The move could travel into the boundary, but it could not hold structural space above it. That is the kind of friction traders often feel but do not name clearly. The chart allows movement. Then it removes tolerance. Once that continuation failed, price was pushed back down toward the lower boundary of the March 10th U.S. session anchor box. This is another reason the phrase "trading between sessions" matters. The movement did not simply reverse in general terms. It was redirected back into the active session box that had defined the recent launch point. Price returned to where the newest structural agreement had first formed. That return tells us something about the environment. The market is not yet operating through clean relocation. It is operating through repeated tests between inherited session zones. Every extension is being judged by an older boundary. Every rejection sends price back toward a newer box. This is also where the 4 Bollinger Band matters. It had contracted first. Now it is expanding again. That combination usually increases visible activity while preserving internal instability. Expansion can appear. But because it follows contraction inside overlapping session structures, that expansion is often uneven. Reaction speed requirement rises. Tolerance width shifts bar by bar. If downward 20 Bollinger slope continues governing the hourly structure, upper tests remain more fragile. If 4 Bollinger expansion keeps widening without durable acceptance, movement can stay active while follow-through remains inconsistent. If price keeps getting passed from earlier boundary to newer box and back again, between-session friction remains dominant. Execution conditions remain in transition. The next anchor formation made the structure even more specific. The March 10th Asia session anchor box formed between the lower boundary of the March 10th U.S. session box and the upper boundary of the March 9th U.S. session box. That means Asia did not begin with open directional space. It began inside a corridor already defined by 2 earlier U.S. references. One was recent. One was older. Both were still active. This is where the chart makes the idea of trading between sessions unmistakable. The March 10th Asia box is not standing alone as an independent event. It is sitting directly between the lower edge of one U.S. anchor and the upper edge of another U.S. anchor. In other words, Asia is processing inside a handoff corridor built by prior U.S. structure. That is not abstraction. That is visible positional inheritance. Since that Asia anchor formed, price has been moving between the March 10th Asia session box and the midpoint of the March 10th U.S. session box. That is a very important detail. The market is not traveling across a broad expansion field. It is negotiating inside a narrow between-session lane. One boundary is the newer Asia anchor. The other reference is the midpoint of the prior U.S. anchor. This kind of environment changes execution conditions again. Distance expectation narrows. Continuation attempts can start quickly, but stall quickly as well. Pullbacks do not need to become large to create holding pressure. Narrow tolerance gets exposed here. Small hesitation becomes structurally meaningful. And that condition becomes even more sensitive because the 20 Bollinger Bands remain sloping downward on both sides. That broader slope continues to apply directional pressure to the hourly environment without resolving the internal box relationship. At the same time, the 4 Bollinger Band has already shifted from contraction into expansion. So the chart is producing visible motion inside a corridor that still remains structurally compressed. That combination is where many viewers misread the chart. Activity is real, but activity is not the same as usable distance. Expansion in the 4 Bollinger Band can increase candle movement. It does not automatically remove the pressure of overlapping session memory. This is why between-session trading must be read through anchor relationships, not speed alone. Here, the anchor relationships are very clear. March 3rd, Asia established earlier structural memory. March 6th, U.S. reinforced that region. March 9th, U.S. formed directly into that overlap. March 9th, Asia inherited the midpoint of the March 9th U.S. box. March 10th, U.S. formed between the March 5th Asia lower boundary and the 20 moving average. March 10th, Asia then formed between the March 10th U.S. lower boundary and the March 9th U.S. upper boundary. That sequence does not describe random volatility. It describes a market passing structural responsibility from one session box to another. Sometimes price rises from one inherited boundary into the next. Sometimes it fails at an older box and falls back into the newest one. Sometimes it compresses between a recent Asia anchor and the midpoint of a recent U.S. anchor. All of that is trading between sessions in visible form. If price remains trapped between the March 10th Asia box and the midpoint of the March 10th U.S. box, failure frequency stays elevated and distance remains limited. If interaction begins persisting beyond that narrow lane, retracement depth may widen before any cleaner relocation can stabilize. If the downward 20 Bollinger slope keeps pressing while 4 Bollinger expansion continues, active candles may keep appearing while tolerance stays narrow. Environment is still processing.